Does gold go up during a recession? Welcome to the Real Money Show, where we deliver powerful and concise information on precious metals, Bitcoin, and other hard money assets. Now, before we cover, does gold go up during a recession? Let's talk about the history of gold and its uses throughout history so we can better understand this asset. Now, I just want to remind you that this is not financial advice. Please seek the advice of your tax professional and/or financial advisor before making any major financial decisions. And at the end of this video, if you want more information on gold investing, there's a free gold kit from one of our trusted partners that I'm going to link in the description below. So first, let's talk about, when is gold a good investment? Investing in gold can be a wise decision driven by the fact that it has an intrinsic value. This means that there's usually a significant demand for gold, and the price should consequently rise, providing a good return on investment. However, as with other commodities, stocks and bonds, the price of gold does not always go up and is subject to fluctuations which can be influenced by a number of factors. When considering gold as an investment, it is essential to understand that it should be seen as a store of value rather than a stock. With stocks, the investment is based on the expectation of future growth and earning. For example, if a stock is trading at $20 today, and its growth is predicted to be 100% in 10 years, then it can be assumed that the price of the stock will also rise to $40. On the other hand, with gold, it is not always the case that the price will rise. It is more of a store of value. Investing in gold should be seen as a way to preserve purchasing power rather than as a way to make money from future growth or earnings. In times of inflation, gold can act as a store of value and can be used to offset the decrease in the purchasing power of currency. Historically speaking, and with exceptions, this means that even if the value of the currency decreases, gold will retain its value, allowing the investor to retain the purchasing power. So what is the price of gold correlated to? So now that we've established treating it as a store of value, though not a perfect one, we need to analyze the price of how gold reacts to different economic conditions. So here are the correlations we're going to be looking at today. Number 1, gold and recessions. Number 2, gold price and inflation. Number 3, gold price and interest rates. And number 4, gold price and the US dollar. Now, after we cover this, make sure you stay until the end, because I'm going to give you what I consider to be the most significant indicator of gold, and what I believe is going to really determine the future of gold in today's world. And this is not financial advice, but something that I'm looking at very closely. So the first correlation that we'll be looking at is gold price and recessions. Historically, gold prices and recessions have had an inverse relationship. When the economy weakens, investors often turn to gold as a safe haven asset, driving up its price. This was certainly the case in 2020, 2007, and 2001, when the S&P 500 decreased while gold prices increased. Nevertheless, it is important to take into account the entire economic context before assuming that gold prices will always rise during a recession. For example, according to Forbes.com, during the recession of 1980, gold dropped by 5%. Therefore, investors should not simply rely on one single indicator when deciding whether gold is a suitable addition to their portfolio. The next correlation that we'll be looking at is gold price and inflation. When inflation is on the increase, gold prices often follow suit, as investors view it as a hedge against inflation. But some research has shown that gold does not always perform well during highly inflationary periods. For instance, according to Forbes.com, between 1980 and 1984, gold prices decreased by 10%, while inflation was at 6.5%. Likewise, prices decreased 7.6% in the years 1988 through 91, with an inflation at 4.6%. This has led some experts to conclude that gold is not a reliable hedge against inflation. However, such an analysis fails to take into consideration the entire economic picture. Let's look at the years 1980 through 1984 in particular. During this period, the US economy was in a recession and inflation was high. However, President Reagan cut taxes and eased government regulations, which in turn caused the S&P 500 to increase by close to 26% in 1980. As Americans had more money in their pockets due to the tax cuts, there was not a strong demand for gold. The next correlation that we'll be looking at is gold prices to interest rates. The correlation between gold prices and interest rates is a complicated and often contentious issue that has been debated by economists and investors for decades. On the one hand, some argue that gold prices are inversely correlated to interest rates, meaning that when interest rates rise, gold prices tend to fall, and vice versa. The conventional wisdom states that gold prices and interest rates are inversely correlated, primarily because when interest rates are high, investors are more likely to invest in other assets, such as stocks and bonds, that offer higher returns than gold. As a result, demand for gold falls, causing its price to decline. In addition, when interest rates are low, investors may become less risk-averse, which could lead to increased demand for gold, pushing its price up. On the other hand, there's evidence to suggest that gold prices may not be as influenced as significantly by interest rates as we once believed. Recent empirical evidence has shown that there's actually a limited correlation between gold prices and interest rates alone. For example, a study by the Federal Reserve Bank of San Francisco showed that while gold prices tend to decline when interest rates rise, the effect is actually quite small and not statistically significant. There's one final correlation that we're going to look at before we discuss that main indicator that I talked to you about at the beginning of the video. And the final correlation that we want to look at is price of gold and the US dollar. When the US dollar weakens, gold prices typically rise, and conversely, when the dollar strengthens, gold prices can also increase. This is largely due to the fact that gold is priced in US dollars, and a weaker dollar makes gold cheaper for foreign buyers. However, this isn't always the case, as evidenced in 2020 when both dollar and gold prices fell. In 2019, despite the dollar's strength, gold prices rose due to investors' fears of a possible economic downturn and their desire for a safe haven asset. But once again, one must look at the full economic picture. Now, at the beginning of the video, I mentioned that there was one main indicator that's getting me to really look closely at gold. Now, this is not financial advice again, but simply something that I am looking at very closely to determine where I think gold is going. Now, over the last year, different central banks around the world have been buying gold in record numbers. 3 economists, 2 from the International Monetary Fund and 1 from the University of California at Berkeley, have published a new report pointing out that gold, far from being on the way out as an international reserve currency, has been coming back in. In this published report, they write, central bank holdings have risen since the global financial crisis. Central banks have been stockpiling bullion over the past 15 years, more than making up for the net sales of the previous decade. Additionally, central banks worldwide bought more gold in the third quarter of 2022 than any other quarter in 55 years. The buyers have been the so-called emerging, developing, and sometimes submerging countries such as Russia, China, India, Turkey, Argentina, Hungary, Belarus, and others. Some 14 of them have hiked gold as a share of reserves by more than 5 percentage points so far this millennium, the same economist reports. So why are central banks hoarding all of this gold? The economists continue to say, gold is perceived as a safe and desirable reserve asset when countries are subject to financial sanctions and when financial investments are potentially subject to asset freezes and seizures. The decision of the G7 countries to freeze the foreign exchange reserves of the Bank of Russia last year after the invasion of Ukraine directed attention to whether reserves might be held in another form better insulated from sanctions. Now, most of the world is against the Russian invasion of Ukraine, but that is completely besides the point. The fact is that different countries around the world are paying attention to the actions of the US and are trying to protect themselves against future sanctions against the West. And it appears that one way they are doing so is by hoarding gold. In fact, the BRICS nations are rumored to be working on creating their own version of a digital currency, most likely backed by gold and other commodities, something that relies less on the US dollar. Russia, Iran, and other countries subject to US sanctions may now be talking about combining blockchain technology with gold to launch a digital currency to rival the dollar. The currency in question would simply be gold. The blockchain would operate as a ledger, allowing people to transact in gold without actually having to ship coins or bars around. So while the correlations of gold price to recessions, inflation, interest rates, and the price of the US dollar are very important to look at together, the central bank buying and hoarding of gold is, to me, a very important indicator that I will be looking at in my decisions. So when is it the right time to invest in gold? Or when is it not the right time to invest in gold? So I encourage you to do your own research, but I am going to be looking at these continued purchases of central banks and listening to experts in the field. For example, in an April 2020 CNBC interview, respected analyst George Milling Stanley made a case for gold as an attractive asset in uncertain times, recommending that gold make up as much as 10% of a portfolio. Milling Stanley says, "In my view, gold is a hedge against the unexpected, whether it is a hedge against macroeconomic or geopolitical issues like wars or pestilence. It has always been my protection against the unexpected, whatever that may be. Gold tends to perform whenever anything unexpected happens." Well, I hope I was able to shed some light on whether gold does well during a recession, and also perhaps got you thinking about some of the other correlations and things in our current events that could be affecting the price of gold in your investments. As always, make sure you consult with your financial advisor, tax professional that can guide you to what your specific needs are. But if you need to get a little bit more information or a lot more information, comprehensive on gold investing, gold IRAs, the restrictions, the fees, the limitations, the advantages, make sure that you download our free gold kit that is from one of our trusted partners, which I'll link here in the description below. And if you enjoyed this video, as always, please like and subscribe to the channel. That way I know that this was helpful to you and I can make more of these videos. And thanks for watching till the end. See you next time on The Real Money Show.